Hello everyone, welcome to another episode of Personal Finance. It's been a couple of weeks since I posted a video. We're going to take a look at an interesting topic today. How many of you have heard about the term spousal IRA? Have you been using it? Has it helping you in your financial independence? Let's take a look at what it means and how it can help you in your financial journey. Spousal IRA means that you have a high income earner. One of the spouse is a high income earner. The other spouse is typically stay at home. What this allows you is to contribute towards your non-working spouse traditional IRA or Roth IRA. You can also do backdoor Roth IRA as well. So in simple terms, IRS does not have something called spousal IRA. So any high income earner, if one of the spouse is a high income earner and the other spouse is a non-working spouse, then based on the earned income from the working spouse, you can contribute towards your non-working spouse's IRA or traditional IRA. And the contribution limits applies to based on that particular year. For 2025 it's $7,000 below 50, and if you're above 50 you have an additional catch-up contribution of $1,000. So let's say one of the spouse is a high income earner, could be a doctor, could be a high tech or W2 employee, right? You have contributed to your own IRA, 401k and everything else. You still have money left over, right? And you have multiple options how you can use that money. Either you can go towards investment account, which is after tax, or you could buy real estate, or you can do a lot of stuff with that, right? At the same time, typically a non-working spouse does not have IRAs because they have not had an earned income, right? But in this case, what this allows you to do, whatever additional money you have, you can contribute towards your non-working spouse IRA. Once you contribute, then it grows tax-free if it's a traditional IRA. If you do a traditional IRA and make it as a backdoor Roth IRA, right? Once you convert it, then obviously it grows tax-free, and then when you withdraw, it's also tax-free at that point. So it's specifically for high-income earners who would like to contribute towards your non-working spouse. And the limitation, as I mentioned, is same as what a traditional IRA, 7,000, and the Roth IRA, 7,000 as well. The key thing to understand is you have to file taxes as married filed jointly, on short term MFJ, right? Married filing jointly. If you are married filing separately, then the rules change a bit, contribution limit change, and there are income limits that are different as well. There is a link in the description that goes into detail if you happen to be married filing separately, right? If you're married filing jointly from a tax purposes, then it's straightforward. As long as you have additional earned income that you can contribute towards your spousal IRA, you can contribute, and the contribution limit the same as everybody else for that particular year. So take a look at the link. As always, these videos are for information purposes only. It's not a financial advice. Before you make any changes to your financial investments, talk to your CPA, or if you have a financial advisor, talk to them as well. But if you have additional questions, do let me know. The link in the description goes into detail, especially for anybody who is married filing separately. Thanks, bye.